I will be explaining about MFRS 8, which is operating segment. This standard provides guidelines on how companies should report information about their different business segments. MFRS 8, also known as operating segment, is a financial reporting standard that outlines the requirements for segment reporting. It helps users of financial statements understand how different parts of a business contribute to overall performance. The main purpose of MFRS 8 is to give clearer and more transparent information about a company's operations. By reporting segments separately, stakeholders can better see which areas of the business are performing well and which require improvement. Under MFRS 8, a segment is considered an operating segment when it engages in business activities from which it may earn revenues and incur expenses. This includes activities that generate its external revenue as well as transactions with other segments within the same company. An important part of MFRS 8 is the involvement of the Chief Operating Decision Maker, commonly called the CODM. The operating results of each segment must be reviewed by the CODM. This is an important element in MFRS 8. The CODM refers to the person or group of people in a company who are responsible for allocating resources to different operating segments and for assessing the performance of those segments. In most companies, the CODM is part of the top-level management. This may include the Chief Executive Officer (CEO), the Chief Operating Officer (COO), senior management teams, or even the Board of Directors. These are the individuals who have the authority to make major operating decisions. The role of the CODM is important because the financial reporting for segments should reflect the company's actual management structure. Their decisions show how resources are allocated and how performance is evaluated in real practice. In summary, the CODM ensures that segment reporting under MFRS 8 is aligned with how the company is actually managed. This helps provide accurate and meaningful information to both management and external stakeholders. For our group, we choose these two awesome persons as example of Chief Operating Decision Maker (CODM). First, Dr. Oliver Bloom. He is the chairman of the Board of Management of Volkswagen AG. For the second one, we chose Tan Sri Datuk Sri Dr. Ismail bin Bakar, which is the chairman, non-independent and non-executive director Malaysian of KPJ Healthcare. Without further ado, I will briefly explain the automotive or business segment used by the Volkswagen Group in their segmental reporting. Volkswagen structures its operations into several key business segments. These segments help the company measure performance, allocate resources, and understand the contribution of each major division to the overall group results. The first operating segment is passenger cars and light commercial vehicles. This segment includes Volkswagen's core brands such as Volkswagen passenger cars, Audi, and Porsche. It focuses on designing, manufacturing, and selling personal vehicles and small commercial models. This is the largest revenue-generating segment within the group. The second major segment is commercial vehicles. This division handles larger transport vehicles such as trucks, buses, and heavy-duty commercial fleets. Brands under this segment typically include MAN and Scania. Its main role is to serve logistics, industrial transportation, and commercial business needs. The next segment is power engineering. This segment specializes in producing power systems, engines, turbines, and specialized industrial machinery. KPJ Healthcare Berhad presents its financial result based on two geographical segments, which are Malaysia and others. The Malaysia segment is the company's main area of operation and contributes the largest portion of revenue and profit. For the period ended 30 June 2025, Malaysia recorded 1.97 billion in revenue from external customers. It also generated a profit after tax of 158.2 million, showing strong and stable performance in the domestic market. In addition, Malaysia holds the majority of the company's assets, totaling 7.41 billion, and remains the core driver of KPJ's overall operations. The other segment represents KPJ's operation outside Malaysia. This segment contributed 25.3 million in revenue and recorded a small loss after tax of 0.94 million. Compared to Malaysia, the size of this segment is much smaller, with total assets of 255.1 million, reflecting KPJ's limited but continuing presence in foreign markets.
As explained from my friend Akil, using the segmental report from KPJ sector also to explain about two benefits that I got for segmental report. The first benefit of the report is that it helps users to identify which parts of the company's business is the main profit driver. From KPJ's healthcare report, we can see that the Malaysia segment generated almost all of the group revenues and profit, like RM 1.99 billion and RM 237.6 million ringgit respectively. On the other hand, the other segment which is include operations like education and overseas hospitals recorded a small loss. This tells investors that KPJ's core strength is its Malaysian hospital network, and that's where most of the value is being created. So segmental reporting gives a clear view of which business area are growing and which might need improvement. Second benefit is give a clear view of business risks and opportunities. By showing results separately, users can assess how different environments, for example, local versus foreign operation, and effect of the performance. In KPG's case, since nearly all of its revenue comes from Malaysia, investors can see that the group's of result depend heavily on the Malaysian healthcare market. This information helps users evaluate potential risks such as changes in government healthcare policies or economic conditions that might affect KPG's performance in the future. Overall, segmental reporting helps investors to make better and more informed decisions because they can see not just the total numbers, but the story behind them.
In this presentation, I will be explaining MFRS 134, which is Malaysian Financial Reporting Standard for Interim Financial Reporting. So, what is MFRS 134? MFRS 134 is a standard that provides guidelines on how companies should prepare and present their interim financial report. Interim financial report are financial statements issued for a period that is shorter than a full financial year, such as quarterly or half-yearly reports. The main objective of MFRS 134 is to ensure that interim reports contain the minimum required information and follow consistent recognition and measurement principles. This helps make the report reliable, comparable, and useful for decision making. Interim financial reporting is essential because it provides timely and updated information to users such as investors, creditors, and regulators. Instead of waiting for the annual report, stakeholders can monitor a company's performance throughout the year. By following MFRS 134, companies provide information that helps stakeholders understand the entity's profitability, cash flows, liquidity, and overall financial health. This transparency helps investors make better investment decisions and enables creditors to assess a company's ability to meet obligation. These are the few requirements of MFRS 134, which is presenting condensed or complete financial statements. The second one is using the same accounting policies as in the annual financial statement, and the third one is disclosing significant events or changes that occurred during the interim period. For example, if a company has a major drop in sales in the second quarter, it must disclose the reasons such as economic slowdown or production issues so that users can understand the impact. In conclusion, MFRS 134 plays a vital role in ensuring the interim reports are clear, consistent, and reliable. It helps maintain transparency and support informed decision making among all the financial statement users.
First significant event is the dividend payment. On 27 May 2025, 7-Eleven paid a single-tier dividend of 2.7 cents per ordinary share, and this was paid to more than 1 billion shares. So this is quite a big payout. This dividend affects the company in two main ways. Firstly, cash decrease because money is being paid out to shareholders. Secondly, retained earnings also drops, which reduces the company's equity. Even though money is going out, it's actually a positive sign. It shows that the company is financially strong and they have enough profit and liquidity to give returns to shareholders while still running their business smoothly. Second significant event is the big increase in capital commitments. As at 30 June 2025, 7-Eleven recorded an increase in capital commitment as I shown in the info. It's about almost 244.46 million ringgit. This mainly involved investment in new stores openings, store upgrades, and their Cafe by 7-Eleven expansion. This event is important because it affects the company's future cash flows. This commitment also means the company will be spending more money on long-term assets such as equipment, property, and renovations. Over time, this investment will increase non-current assets and may also impact depreciation and future profits. Overall, this shows that 7-Eleven is not just maintaining its business, but it's actually expanding and growing, which is a good sign for long-term performance.
Next, I will explain the interim reporting period for KPJ Healthcare Berhad based on its Quarter 2 2025 interim financial report. According to MFRS 134, a company must present both the current interim reporting period and the comparative period from the previous year. In the KPJ report, these periods are clearly shown in the statement comprehensive income. For the individual quarter, the company reports a financial result for the 3 months ended 30 June 2025, and the comparative figure is for the 3 months ended 30 June 2024. Meanwhile, for the cumulative or year-to-date period, KPG reports the financial performance for the financial period ended 30 June 2025, with the comparative period being the financial period ended 30 June 2024. This reporting period shows consistency with MFRS 134 requirements, which ensure the users can compare the company's performance across different interim periods. This allows stakeholders to observe trends, evaluate changes, and make better economic decisions. So in summary, the current reporting periods are 30 June 2025 and the comparative period are 30 June 2024, presented for both the individual quarter and the year-to-date results.